What's up everyone, welcome to the channel. In this video you will find a lot of free education. Make sure to subscribe because every week I share some free education here on my YouTube channel. Now, as you know, I'm mainly a smart money trader. My strategies are based on smart money, but we need to talk about it for a second. Smart money has great concepts, but at the same time, as you know, 90% of traders are still losing money. And you might wonder why they're still losing money. Of course, psychology has a role in this, but also I will say that smart money by itself is not something that makes you profitable. The concepts are great, but by itself, they don't make you profitable. Actually, constructing and developing a system that works and has an edge on the market is what really makes the difference. I hope that you can really find the informations that you need in order to become successful just by looking at my free channel, but at the same time, in the description below, you can find the links to actually join my course. My course, both the 1.0 and also the 2.0, is included with any membership from the monthly all the way to the lifetime, or also there is the option to have some one-on-one lessons. So make sure to check my website and then I'll see you on the video.
Hi guys, this is Abby from Forex XL. Today, you will learn on how to identify liquidity and the different types of liquidity. So let's start. So what is liquidity? So the markets need to generate liquidity in order to move up or down. So if the liquidity isn't already there, then it will be created. So basically, the basics are like support and resistance, double top, like this one. Like that. Price have this one, double top, because the price have this structure like that one. Or double bottom, this one. Because they believe that if the price go in this zone, and the price will go up. Or a trend line like this one. Then they drew a line of a trend line like that one. And vice versa if it's in the downtrend. So these areas, as you can see here, like in this double top here, these areas has a lot of sellers here. So their stop loss are here. So the liquidity is formed above this prices, as well as on the other types of liquidity like this one, trend line. Liquidity is formed below in this trend line or above this trend line. So let me show you a sample chart. So in this one, so as you can see here, price have this uptrend structure, right? So usually the retail traders draw a trend line like this one. So if the price, for example, we don't know it this yet, we'd like to see. So for example, if the price go here, so you will like put your buy trade in this one and then take profit here. So you expect that the price will respect this area and then go up, because this this trend line is your what you call this? This trend line is your um indication that the price will respect this trend line and then go up, right? But in the liquidity side, the financial institution and the banks seeing a lot of um buyers or stop loss here below here. So as you can see, the movement of the price drops all the way here and catch up all the um buyers or the stop losses below this trend line. So another example is, as you can see here, another example is this one, double top, right? So when you see um, a market behaving like this one, many of the retailers um, suspect that if the price go here, it will be go down. Yes, it's true, but remember that there's a liquidity here. Price will go up there and sweep all the liquidity above this and then go down, as you can see here in the chart. So yes, it somehow manipulates the market. It will make you believe that if the price go here, price will go down. Yes, correct. But eventually, price will move towards on that zone, towards on this area, and will get all the stop loss here. As you can see here, it respects this zone, this one, and then goes down. So that's where we call this equal highs. So when we say there's an equal high, we assume that the price will go up there and sweep all the liquidity above it and then go down. So another example is when we see a double bottom like this one. So when we see a double bottom like this one, we assume that retail traders assume that you go if you see the price here, it will go up. Yes, indeed it will go up. But as you can see, there's a liquidity below on this area. There's a lot of stop loss here because they somehow bought here. And then yes, you can say that it is effective. But you always see how the market behaves on this kind of structure, because it will take it like what it has done on this one. So you have a double bottom here, goes up, yes, but as you can see as well, price went down and then go up again. So as long as we see this kind of structure, we can see how the price moves or reacts on those areas. So when we see a market like in this one, like in an equal low, or retails are saying that it is a double bottom. So people thought that they will buy on this area, and so it generates liquidity below on this area. So we know that this area gets manipulated every time. So that's it, guys. I hope that you learned something new today, and we'll see you on the next lesson. Bye.